Welcome, fellow investors, to another episode of Money Matters Unplugged. I'm Shauna, your host. Today, we're delving into a topic often at the heart of investment decisions: the showdown between two heavyweights in the financial world, mutual funds and exchange-traded funds, or MFs and ETFs. So grab your favorite beverage, settle in as we take a virtual train ride with Robin and Troy in the mutual funds versus ETFs face-off.
Hey, what are you reading that's got you so focused?
There is a great article that breaks down some of the major differences between mutual funds and ETFs.
I don't know much about either one, except that both are a basket of securities that offer ways to diversify investments.
A basket of securities is like a big bag with lots of different investments inside. This single entity, or basket, can hold things like stocks, bonds, currency, and other investments domestically or from other countries.
Just by owning XYZ, I get to invest in all these other securities.
I guess that's why investing in indices, such as the S&P 500, is so appealing.
Well, investors don't directly invest in indices. Instead, they trade funds that mimic their holdings. The S&P, Dow Jones, and Nasdaq Composite are the top three in the United States. Each has its unique investment methodology. There are countless indices available for a fund to track that align with the fund's overall investment objective. An index can be founded on various factors, including by sector, location, asset type, or even capitalization. The fund's goal is to replicate the index's performance where the profit returns are pretty much in line with one another. Sometimes, the fund may not do as well and yield a lower return than the index. Like any investor's dream, the fund has the potential to outperform the index, giving a higher return on investments.
Mutual funds and ETFs share similarities, but what are some of their differences?
One major difference is how they trade. ETFs offer greater flexibility since they are traded throughout the day on an exchange, just like stocks. Mutual funds, however, are bought and sold at the end of the trading day. The price of execution is at its net asset value once it's calculated. NAV calculations are performed nightly for both funds. Its simple calculation is the fund's assets minus its liabilities, divided by the number of shares outstanding.
The outstanding shares are the number of shares available in the market. So what happens if there is no more inventory to meet demand? I'm glad you asked. Issuers establish special relationships with institutions. When they need additional shares, they contact the issuer to create additional shares to trade in the market. The same would apply if there were shares in excess.
NAV is computed at the end of the trading day for both types of funds, but only mutual funds ensure execution at that price. Since ETFs actively trade throughout the day, execution happens at market prices.
Wouldn't that mean ETFs can be bought and sold above or below its value?
That is exactly right. Checking the issuer's premium discount report, investors can monitor such occurrences. I'll leave you with some key differences in the battle of mutual funds versus ETFs to consider. We now know mutual funds are executed at NAV while ETFs trade at intraday at the market price. Intraday trading gives investors more opportunities to take advantage of short-term market movements. Mutual funds are often managed by professionals who make investment decisions. Conversely, ETFs are typically passively managed, meaning they track a specific index without frequently buying and selling. Actively managed funds typically have higher fees, which can cut into your investment returns. Mutual funds and ETFs help you spread your money by diversifying, an essential part of any risk management strategy. Mutual funds may have a higher level of risk management since they are watched by professionals. Passive investments may carry greater risk exposure since they are limited to the trading parameters of the tracking index.
So, which one should I choose?
Ultimately, the choice depends on an individual's goals, risk tolerance, and preference. If you prefer a hands-on approach and are willing to pay a bit more for professional management, mutual funds might be your choice. On the other hand, ETFs could be the better option if you're looking for cost efficiency and flexibility.
My stop is next. That was great info. Thanks for that quick lesson. Can't wait to see what you teach me tomorrow. Same train?
Yep, same train. Have a good day.
I think I'll drive tomorrow. Don't want to start what I can't keep up.
Hey, you're back. Well, that about does it for today. Stay tuned for more on funds, where we will quickly cover expense ratios. See you soon.